Hey everyone, Priya here, and welcome back. We've all heard that old saying, right? Don't put all your eggs in one basket. It's good advice. But what if the basket itself is a little bit broken? In this explainer, we're going to move past the cliches and learn how to build a portfolio that's genuinely resilient, one that's actually ready for whatever the market decides to throw at us. Let's jump in. So, a lot of us Indian investors, we feel pretty safe. We put our hard-earned money into a Nifty 50 or a Sensex index fund, and we think, great, I'm diversified across the biggest companies in India. Job done. But is that really the full picture? I think we need to look a little closer. I can almost hear you thinking, Priya, come on. It's 50 of the top companies in the country. Of course it's diversified. And look, I get it. It seems logical. But let's just pop the hood for a second and see what's really going on in there. Because the truth, well, it might just surprise you. And there it is. Just look at that chart. More than a third, we're talking nearly 37% of the entire Nifty 50 index is tied up in just one single sector, financial services. Think about that. That means if the banking sector has a bad year because of, say, interest rate changes or a rise in NPAs, a massive chunk of your quote-unquote safe portfolio gets hit hard. It's a huge hidden bet on a single industry. This right here is the problem we're talking about. It's got a name: concentration risk. It's when one part of your portfolio has so much weight that it has the power to sink the entire ship. So your safe, passive investment suddenly isn't so safe if that one sector stumbles. Okay, so that's the problem. It's a bit scary, I know. But the really good news is that there's a powerful, time-tested solution to this. And in the world of investing, it's famously called the only free lunch you will ever get. And that's not just some catchy line. It comes from a Nobel Prize winner, Harry Markowitz. What he actually proved, with math, is that by combining different types of assets, you can lower your portfolio's overall risk without having to give up your expected long-term returns. MATLAB, you get less risk for pretty much the same reward. Now that is a deal I think any of us would take. So let's be super clear. True diversification is not just about owning 50 different stocks. It's about spreading your money across different kinds of investments, things like equities, debt, gold, and across different sectors that don't all go up and down in perfect sync. It is, quite literally, your portfolio's built-in shock absorber. All right, theory is great, but how do we actually put this into practice? Let's start with a really simple but powerful safety rule you can apply to your portfolio, like today. Think of it as your first line of defense against doing something silly. We call it the 5-25 rule. It is not complicated, it's not some high finance secret, but it is incredibly effective at protecting everyday retail investors like you and me from a devastating loss if one company or a whole industry hits a rough patch. Okay, first part, the 5. No single stock, and I don't care how much you love it, whether it's Reliance, HDFC, or TCS, no single stock should ever make up more than 5% of your total portfolio value. This simple rule protects you from a company-specific disaster. And now for the 25. This one directly tackles that Nifty 50 problem we just saw. No single sector, whether it's banking, IT, pharma, you name it, should ever be more than 25% of your total portfolio. So, while the Nifty is sitting at nearly 37% in financials, a truly diversified portfolio brings that right down to a much safer 25% max. Okay, so we've put our defenses up. Now it's time to build the thing. Let's look at a super simple blueprint that helps you tailor your portfolio based on the single most important factor there is, your age. It's called the Rule of 100. It's so easy you'll never forget it. All you do is take the number 100 and subtract your current age. That number you get? That's the percentage of your portfolio that should be in equities or stocks. The rest? It goes into safer things like debt and gold. Simple, right? To get? Let's see this in action. Say you're 25 years old. 100 minus 25 is 75, so you should have about 75% in equities. You're young, you've got decades to recover from any market dips. But fast forward, now you're 45. Your equity allocation should be down around 55%. See how that works? As you get closer to needing the money, your portfolio automatically gets safer and more conservative. It's a brilliant way to manage risk throughout your life. So what about the rest of your portfolio? Well, that goes into our classic Indian debt instruments like PPF and fixed deposits, and of course gold through SGBs or gold ETFs. Now, here's a really timely tip for 2026. A lot of experts are suggesting you might want to boost your gold allocation to somewhere between 10 and 15%, which is much higher than the usual recommendation. The thinking is to add an extra layer of stability, just in case the markets get a little choppy. Now, once you've set up this beautiful, balanced portfolio, you might be tempted to think the job is done, but it's not a set it and forget it kind of thing. Your portfolio is a living, breathing entity. The market moves, prices change, and your perfect allocation can get thrown completely out of whack. That is why you need a regular checkup, something we call rebalancing. This slide shows the problem perfectly. Let's imagine you started with a 70% equity and 30% debt portfolio. Then, the stock market has a fantastic year. Your equities grow, and now they make up 75% of your portfolio. This is called portfolio drift, and without you doing a single thing, you are now taking on way more risk than you originally planned. Rebalancing is just the simple act of selling a bit of your winners and buying more of the asset that's lagging behind to get back to your original 70-30 target. And here is how you do this the smart way, specifically for us here in India. First, just check your portfolio every 6 to 12 months. Don't obsess over it. Only do something if an asset class has drifted more than 5% from its target. But here's the killer tip. To avoid paying that pesky long-term capital gains tax, don't sell the winner. Instead, just direct your new money, your monthly SIPs or your annual bonus, to buy more of the asset that's fallen behind. This is such a smart, tax-efficient way to get back in balance. Wow, okay, we have covered a lot of ground today. We started by finding a hidden risk in the most common investments out there, and we've ended up with a plan to build a robust, age-appropriate, and easy-to-maintain portfolio. So let's just pull all of this together into one simple, clear action plan. So what do you need to do tomorrow morning? It's just 3 steps. Step 1, play defense. Go look at your portfolio and apply the 5-25 rule. Step 2, build your blueprint. Use the rule of 100 to figure out your personal asset allocation. And step 3, schedule your checkup. Put a reminder in your phone or calendar right now to rebalance every 6 months. That's it. You can do this. So, I'll leave you with a little bit of homework. After everything we've talked about today, I want you to take an honest look at your own investments. What is the single biggest hidden risk, that one overconcentration, that you are going to fix this week? Thanks so much for joining me.